Hi, everyone. Apologies for the delay. We had some technical difficulties, but no, I want to thank everyone for joining me today and welcome you to Disrupt Equity's Investor Power Hour. I'm Chris Ingle, Vice President of Investor Relations here at Disrupt, and today we're going to dig into something that I believe is very useful of where you, no matter where you are in your investing journey. We're going to go through the major commercial real estate investment classes: office, retail, industrial, multifamily, hospitality, and a few specialty plays. Look at the pros and cons of each and talk about how to think about which ones make sense for you and your investment situation. Okay, perfect. Okay, we'll start with the investment case for commercial real estate broadly and why this asset class. Then we'll go into each major property type, do a head-to-head comparison, and cover some of the key metrics that you would need to know, and talk about a matching strategy for your specific investor profile. And at the end, we will go through a more in-depth overview of multifamily, more specifically value add in the Sun Belt region, and then we will open it up to Q&A. Yeah, if you're on this call, you probably already believe in investment in real estate. But let me put some numbers around it because it just makes the case that much stronger. Historically, commercial real estate has delivered 8 to 12% total returns, and that is the combination of cash flow and appreciation. And there is very little correlation to equities in the stock market. That makes real estate a great diversifier for your overall portfolio. And it's not just an alternative to equities. There are three fundamental advantages to investment in real estate. Number one, it's a hard asset. So you get something physical and tangible, and it can be collateralized and it does appreciate with time. It generates income through leases, which are contractual, and in certain asset types can be carried out over several years. And finally, you can use leverage, and not enough people talk about that, but that can increase your returns very significantly. And the other thing that does not get mentioned very often is investment in real estate is a great inflation hedge. And as we have seen over the last few years, the dollar has decreased a ton in value, and we have seen real estate values go up. And now we're going to go through the six major buckets across the real estate landscape, which are office, retail, industrial, hospitality, and multifamily. And then there are also some specialty plays like self-storage, data centers, and senior housing. Each one does have a completely different risk profile, intensity of management, and relationship to the economic cycle. And each one does perform very differently and is not directly correlated to equities, which can be advantageous. But I will jump right into office. And office over the last few years has been very complicated just due to a lot of the headwinds post COVID. On the positive side, you're typically going to get a lease of 3 to 10 years, which is great. It gives people a good long runway, and you can also get rent premiums in cities like New York or San Francisco. And you can also structure your leases as a triple net, which means that the tenant is going to pay the operating expenses. And this does provide, of course, great protection for you as an investor. And as I mentioned earlier, the biggest challenge and what has happened recently with office is the remote and hybrid work, which did happen as a result of COVID. That has created just a fundamental change, and vacancy numbers have gone up. Currently they're around 18%. In certain markets, they are higher. And when tenants leave, it just takes a long time to get it filled back in. You're typically looking at 1 to 2 years of getting a new tenant in there. And oftentimes you have to build out the suite or the space to accommodate those new tenants. And that just requires a lot of substantial investment. The one bright spot that we have seen across office investment has been in the medical space because you're largely insulated from that work from home trend. And also, we do have an aging population, which helps drive up the need for that. And now we're going to transition into retail. It does a lot of times get kind of what I would consider a negative connotation. And yeah, it is deserved in certain cases, but there are still very good opportunities there. The segment of retail that has excelled and received a lot of attention is the single tenant net lease, kind of like dollar stores, fast food, auto parts stores. These leases, you have institutional quality tenants, and they are long term. You're looking at 10 all the way up to 25 or 30-year leases, and that tenant is paying the operating cost of the property. It's structured, similar to what you would get with a bond, where you know what you're going to make. Cap rates, are pretty good, typically between 5 and 7%, and you do get good passive income with minimal management and minimal risk. Uh, the other part of retail that has performed pretty well is the grocery anchored tenant facilities, and also the necessity based retail. And when I say necessity based, I'm thinking grocery stores, pharmacies, things like that. One place that I probably would avoid is malls or shopping centers that just don't have a strong anchor tenant, which will drive in people. There just has been a large flight to quality, and it's been happening for a long time now, and it's just honestly has just been expanding. And as far as industrial goes, this has probably been the best performer in the last 10 years in commercial real estate. And a large driver of that has been e-commerce. And with that expansion, you need additional warehouses, and a lot of them. Rents nationally have gone up over 40% since 2020. That is just impactful. Vacancy is low. You're typically seeing around 5%. And the fundamentals are just, they're really there. It's simple, it's easy to understand. There's low capex requirements. You have functional buildings, long-term tenants that are institutional quality, and you just can't build on already developed land inside of cities. This has helped accelerate the growth of your urban infills for last mile logistics. That has performed exceptionally well. And one of the downsides of it, though, is due to the recent success, as with most things in investing, we have seen a significant increase in supply over the last few years. And that has created a bit of softness in the markets that previously did not exist. It's still a great investment class, but I would say you would need to know and understand the particular submarket that you're investing in, and just make sure that that particular deal makes sense. And now we're getting into the thing that I know best, multifamily. And it's accessible for everyone. It scales. I think the best use case for it is people need housing. Vacancy spikes historically have been shorter than any other real estate class. We also have the benefit of agency financing. there is such a need for housing in the United States that we have special financing terms that other asset classes can't get. And that is beneficial to investment in real estate. We utilize Freddie and Fannie all the time in our deals. And yes, there has been a supply challenge in the Sun Belt over the last few years. But the good news is people are still moving to the Sun Belt, and a lot of that new supply has been absorbed. And that has also been combined with new developments have decreased a ton over the last few years just due to that supply wave. And the fundamentals have come back in the markets that we're in. And we'll go into a little bit more depth later with that. But it is where I believe the best risk adjusted opportunity in commercial real estate is currently. And we're going to move into hospitality, which generally speaking, that is a lot more higher risk, but also higher reward. It's very sensitive to economic downturns. There are no long-term leases. Prices change daily, and that can create challenges for a deal. When the economy turns negative, occupancy will fall, and the associated costs associated with hospitality do not go down at the same rate. The good news is that leisure travel has recovered a lot since COVID, and in some markets, it's actually overperforming the pre-pandemic levels. You do get compensated fairly well with cap rates being in the 7 to 10% range. And hospitality, really, it's more so for your seasoned and experienced operators that really understand the operations. And I would say it would be very challenging for a passive investor to get into hospitality just due to the level of experience and knowledge that's needed to go into it. And we're getting to the specialties or alternatives, space, and that has been attractive in a lot of places. Some of the most attractive over the last few years has been self-storage, data centers, senior housing, medical facilities. These used to be considered niche, but there has been an investor appetite, and we're starting to see institutional dollars come into it from pension funds, endowments. Self-storage, I would say, is probably the most accessible for your individual investors. There's low operating expenses. It is recession resilient. Uh, Going into data centers, that is one I have been hearing a lot about recently. And with the growth of AI, rents have grown over 30%. And the trade-off with that is it does require a lot of capital investment and a lot of expertise to get into that. And a great play that I have been seeing a lot is the senior housing. It's a great demographic play. You have over 10,000 baby boomers that are turning 65 every single day for the next year, and senior housing is going to have to fill that demand. And this is a head-to-head comparison that I put together. This table is designed to just kind of give you a quick view of the trade-offs for the six different asset classes. Some things that stand out to me is industrial and multifamily, have the best combination of moderate risk, strong yield, and a manageable management. Hospitality is, as highlighted earlier, a lot more high risk, high reward. And office and retail are kind of in the middle. They've had their own challenges over the last few years, but if you get into the correct deal in the correct market, it can make sense. I think the overarching thing is there is no free lunch in investment, and there is always going to be a trade-off in every investment. And really, the question is, which trade-off fits your individual situation the best? And we've touched on all the major asset classes fairly broadly. but now I want to go into the asset class that I know a lot more and can give a picture for why multifamily is investment right now and some of the risks that are associated with it. There are three numbers at the top of that slide that really stand out to me. And the first one, there is a housing shortage in this country, 4.5 million. And that is a structural problem that has been built up for several decades. And it's not going to be fixed next year. And it probably will not be fixed in the next 10 years. The other thing is 66% of renters today say they cannot afford to purchase a home. It's not that they do not want to purchase a home, it's because they are not in the financial position to do so. High mortgage rates, elevated prices have locked out a generation of buyers, and they are now renters. And the last number, $422,000 is the median home price in the United States. And that is up 45% since 2019. These three numbers break the affordability math for many families in our country. And multifamily real estate is a direct beneficiary of that. Millennials are the largest generation in the US, and now Gen Z is entering the rental market. And with the access that we do get to agency financing, this does position multifamily real estate very well over the next few years. And historically, multifamily real estate has outperformed recessions. There are less vacancy spikes, and they do last a lot shorter than other asset classes in commercial real estate. And I think that the Sunbelt opportunity, particularly in Texas, is a great place to invest. In Houston, it's a market that you have the number one population growth in the country for large cities. It's projected to be the same way over the next 10 years. We have diversity of industry here. Houston in the 1980s used to just be an energy or oil and gas town. Now we have medical facilities. It's the number one place for medical in the entire country. We also have lots of other companies coming here. And we have that diversification that just did not exist previously. Rents have stabilized here from some of the excess supply that we did receive in 2022, 2023. And there's just not a lot of new construction in the pipeline. It's very limited right now. San Antonio, in my opinion, is a very underlooked opportunity. Everyone kind of gravitates towards Houston, Dallas, and Austin with good reason. But San Antonio had 4.5% population growth in the last year. You have positive income growth. It's a great place to be. The cost basis is also a lot lower than you'll get in the other markets that we operate in. So that gives you the opportunity to find deals that really pencil in and can get you early cash flow. Dallas, has been a machine for several years. You're having corporate relocations. Some of that is highlighted, in the slide. It's the eighth largest metro area in the country, and absorption was strong even over the last few years. Lastly, this brings me to Austin. Austin has been in the headlines a lot due to oversupply issues that they did have. Rents went down a lot there. But I would argue, due to prices coming down, that's a great time to get into a good deal in Austin. There still is the long-term job growth there, and it's going to continue to grow. 11 of the 15 fastest growing cities in the US are here in Texas, Florida, and also the Carolinas. There is no state income tax. And that just provides, what you would really want for an investment. And additionally, you have net migration that has been positive. And the supply wave has been corrected. So the fundamentals are really there. And I'm transitioning into value add. That's what we do at Disrupt Equity, and it's very simple. We buy a property that's underperforming, we improve it operationally, and we apply forced appreciation. Step one, we find a deal that is below replacement cost, and construction costs, have gone up a lot post COVID. So that does provide a good equity cushion for deals that we are purchasing, even before we perform any unit renovations. Step two, we do perform those unit renovations. We're going to renovate bathrooms, kitchens, flooring. We also do exterior and common areas, bring something that's welcoming to tenants that come into the property. We have seen rent premiums, we would target between 150 to 250 or $300, depending on the unit and the city that it's in. Step three, we bring in our management team. We have a great team here, Merge Living, and that is really, in my opinion, what makes or breaks a deal. If you do not have good management in there, the renovations won't do anything because tenants will leave the properties. So it is so important to have a great property management team there. And after all of that, the last step is stabilization of the property. We need to get the rents up to where the market is. And the last step is what investors love so much, the exit or the refinance of the property. We can either do a cash out refinance, reduce that overall equity risk for investors, or outright sell the property and give investors great returns. And here is some of the risks that you do have for investment in multifamily real estate. Uh, investors who do make the best decisions are the ones that do think about the downside, in my opinion, not just what can go right. The biggest risk that has existed over the last few years in the Sun Belt has been the oversupply, which we have highlighted several times in this presentation. We did see record multifamily units delivered over the last few years. In turn, vacancies have risen, and that does impact overall returns for investors. And that is why it is so important to underwrite conservative rent growth and also to focus on markets that don't have that oversupply. It's important to look at the data and also check the data independently. Don't just rely on the data that's being presented to you by different sponsors. Interest rates sensitivity, it does impact deals as well. Higher rates can compress your returns, and it will cause cap rate expansion, which is, as I'm sure you know, bad for deals. And it can reduce the overall returns that you have. One way to mitigate that a bit is to have fixed rate agency debt, or I have seen groups use interest rate caps, but you have to stress test your deals and make sure that they work and make sure that there is a margin of safety in there. And the other thing that has been a bit unique to Florida, Texas, and a lot of your coastal properties is insurance. We have seen insurance go up, in some properties 25, 30%. I've had conversations with competitors where insurance have gone up over 100%, and that just materially impacts deals. And that is a risk that I think a lot of people did not see over the last few years, and it has impacted returns. And the risk, in my opinion, that is the largest risk is there is an operational risk. You need to pick good sponsors. Value add multifamily investing is not passive. It depends on an operator and their execution. And I just think it's extremely important to vet those operators, their track record, and especially in the market that they're operating in. And the last overall risk is the market that you're in. We invest in Texas and landlord-friendly states. There is no rent control. But if you were to invest in a California or New York, that is something that you should assess. And that is something that you should underwrite to when assessing those deals for investment. And is multifamily investment right for you? Two things, on this slide: who it's a fit for, and the checklist on any deal that I would be evaluating. On the investor side, you need to know and understand that it is a 5 to 10 year commitment, and you need to be comfortable with that. The nature of investments in multifamily real estate it is a liquid, but the trade-off for that is you get to build long-term wealth. You get monthly distributions, cash flow. You get appreciation of the property. Additionally, you do have tax advantages. You can get bonus depreciation, or if you use a 1031 exchange, you can utilize that as well. The kind of other thing that I would look for is I would look for the submarket. I would also look for the overall construction pipeline in the area. Make sure that there is job growth and in that particular MSA. And as highlighted earlier, and it is so important, you want to find properties that are priced below the replacement cost. And additionally, the biggest risk and something that you should look for is you need to go with a strong operator because you can buy the best deal in the world, but if you have a bad operator, it's not going to go well. So that is, some of the things that I would look at for a deal. And some of the key takeaways. We've touched on a lot of real estate in this presentation. We've covered the entire landscape of investment in commercial real estate, and where I believe the most compelling opportunity is in the market right now, which is multifamily. I hope this has been useful, regardless of where you are in your investing journey. And if anything has resonated with you, feel free to reach out to me. Invest at disruptequity.com. Additionally, you can click or you can use the QR code and book a time directly with me. And I do want to open it up for questions. And if you do have questions, you can put it in the chat. So, okay, here we go. Hey, Andrew. The question that Andrew asked is, have we looked in the El Paso market at all? He has heard good things. For the moment, we've looked at deals out there. I think the challenge with us as a company is we want to manage all of our properties, and we just currently do not have the infrastructure there currently. But I will never say never. I think with some time, there's a pretty good chance that we would expand there. And I have heard similar things and actually have a few friends that have invested there as well. Thank you for your question. And Keith has asked, are there any multifamily deals that we're looking at right now? Keith, absolutely. We have about 10 offers out right now. Where we are concentrated in our offers, we have offers out in San Antonio, Dallas. We have offers out in Houston. The other market that we've been looking at a lot, and we feel like there is a lot of great opportunity, is in the Atlanta market as well. Thank you for your question, Keith. Are there any more questions for anyone? Okay. Hey, Jason asked, "What's my experience with RV parks?" Great question, Jason. We do not have any experience with RV parks. That is not an asset class that we have invested in. I have seen people be successful with it. but I just don't know a ton about it, so I probably would not feel comfortable just commenting on it. And thank you for your question. Are there any more questions? Well, I want to thank everyone for joining me today. It was a great time. If there are any further questions or you want to talk to me, feel free to email invest@disruptequity.com, or you can reach out to me directly, cingle@disruptequity.com. I really appreciate everyone joining, and see you all soon.